Hey traders, Ron here, Traders Academy. And as you know, it's our goal to coach and train traders of all levels. Typically we do that through our podcasts, our blogs, our meetups, and our webinars. But a few weeks ago we had the idea to put out through social media a question to all of you asking, what is your biggest challenge or obstacle that's preventing you from creating consistent trading results? And the response was overwhelming. So what we decided to do was take those responses and create a series of mini courses, each one answering a specific response. So we hope you enjoy these, hope you find them informative, and thanks for watching. Welcome to mini course number 5, Futures, How to Trade Futures in Large and Small Accounts. And this is part 3 of our 4-part series. And just to recap, the question was, I really feel more comfortable trading commodities and stocks, but I've always been told that they are very high risk. I only have a small account, so I've never really gotten involved. How should I begin if I want to trade futures, and is there a way I can trade without having the excessive risk associated with futures? Any help would be great. So first I want to say again that the futures market is by far my favorite market to trade. But at the same time, I'm a firm believer that to be fully and properly diversified, you need to maintain positions in all 3 markets. Those would be equities, forex, and futures. By doing this, you'll be much better placed to offset the wild market swings in the equities market, especially ones like we've seen lately. So don't give up on the other 2, as you're going to need them just as well. But for now, let's be more specific and answer your question. So first part of your question was asking how you should begin if you want to start trading futures. And we covered that in parts 1 and 2. So now let's work on the second part, which was, is there a way I can trade without having the excessive risk associated with futures? We first started in parts 1 and 2 with the standard method practiced by most futures traders, and that is either buying or selling, which means going short, a futures contract. For you, the problem with this method is that it carries the greatest risk because of 2 factors. The first being the associated large capital outlay required to cover the margin required to either buy or sell a futures contract. Then the second is the fact of the high level of leverage involved with all futures contracts. This means that any small move in the price of the futures contract would result in a relatively large move in your account. And if the price moves against you, that amount could be staggering. So now let's look at several ways that you can lower that level of risk and still trade commodities. And the first way to lower that risk would be to trade mini contracts instead of trading the full-size contracts. And these are typically 1/10 the size of what the full-size contracts are. So this would considerably reduce your risk and your exposure and still allow you to trade the commodity directly. But the problem with this is that only a few commodities have mini contracts available, so this would only be a limited solution for you. But another way you could trade commodities and lower your risk and the required capital would be through the use of options. And the good news is that you will have several option strategies available. Now this will require you to do a limited amount of technical analysis in order to construct your trades. And it will also require you to have some knowledge of option trading. So for this mini course, I will assume that you understand option basics, because if not, then this would end up being a totally different mini course. And I'm also going to make the assumption that you're skilled in technical analysis, because again, if not, this would be still yet another different mini course. But I have covered quite a bit of technical analysis in prior mini courses, so you may want to go back and check those out if you haven't already read them. The following is a list of data that you will need to collect via the charts and through the use of technical analysis. Number 1 being, you will need to determine the overall trend of the commodity. Is it up, is it down, or is it trending sideways? You will need to identify areas of support and resistance. Or another way of looking at this is you will need to identify a range that the commodity is or has been trading in. And last, you will need to go to the options table for your chosen commodity and identify an option that would be expiring in about plus or minus 30 days from now. Now, in this last item, there is one thing that you will need to keep in mind, that there is, based on what brokerage firm you trade with and what trading platform you're using, every commodity may not have options that you can trade. So this will be one negative you'll have to deal with. So it may be a good exercise to go through the commodities on your trading platform and note which commodities have tradable options and which do not. Then you will need to stick to that list when doing your analysis. So once you've chosen the commodity you want to trade from the list of commodities that have tradable options, then you will want to perform the required technical analysis that I listed prior to this. Now, You are ready to construct your option trade. If you've been following any of my other mini courses or my blogs or my podcasts, you will know that my favorite option strategy is selling options. And you guessed it, this will be no different. I'm going to show you how you can sell options against your chosen commodity and drastically lower your risk while getting double-digit returns. Okay, if you're ready, then let's look at several different ways you can use options to achieve your goal with commodities. First, let's break it down into 3 possible scenarios. And of course, this will be determined by your technical analysis. Number 1, the commodity is trading in an uptrend. And if that's the case, you could either sell a naked put or you could sell a vertical put spread. Or if the commodity is trading in a sideways pattern or a sideways range, you could sell a strangle or you could sell an iron condor. And number 3, if the commodity is trading in a downtrend, you could sell a naked call or you could sell a vertical call spread. Now let's look at the pros and cons of those different trades. To make this simple, let's combine trade A from each scenario since they all are basically in the same category. Each of those trades consists of selling naked options. And by doing this, you will have the following. First off, you'll have less capital required, or margin, versus the buying or selling of the outright commodity. Number 2, far more capital required than any of the B trades in each scenario. And number 3, you're going to have a greater percentage return than any of the B trade scenarios. But here's the problem with these trades. Since you're selling naked options, then your risk is somewhat unlimited, which is something you wanted to get rid of based on your original question. So therefore, the return was greater than the B trades because the greater the risk, the greater the reward. But your first goal should be to reduce risk whenever possible. So let's agree that we'll be eliminating the A trades and stick with just the B trades. So these trades, since they are not naked, provide you with predefined and limited risk. You know up front what your max loss could be. You also decrease your required capital to such a small amount that I think you're going to find it hard to believe. And these trades will still provide great double-digit returns and actually in the 20 to 30% range month after month. So I think that sounds good, right? So as you can guess, this brings us to the point where we need to go into our trading platform and show you exactly how to construct these trades. And this will lead us into part 4. So be sure to check out our next and final part of your mini course where we will put all this together. So we'll see you in part 4. But in case all of this still seems too large of a task for you to take on, I would like to suggest another option. Instead of taking all this on by yourself, you should maybe consider coaching. Coaching is something that is used by every successful professional, at the same time, something that is almost never thought about for the average person. But think about it for a second. Pro golfers have coaches, pro boxers have coaches, sports teams have coaches, pro skiers have coaches, actors have coaches, even rock bands have coaches. And the list could go on, but I think you get the idea. And one thing you may not know is that traders have coaches too. In fact, I can promise you that all successful professional traders have coaches. In fact, all large brokerage firms employ in-house coaches to support their in-house traders. And when I worked on Wall Street, I used their in-house coach all the time. But whatever path you decide to take, I just want to encourage you not to give up on your dream to become a trader. There's not another business in any field that has the potential to produce the kinds of gains possible as a trader. Remember, it's about following the process, breaking it down into workable sections that you can tackle with ease. And remember, if you don't feel like going it alone, consider coaching. We want to thank you for watching. We hope you enjoyed it and hope that the information that you got can in some way help improve your trading. And if you'd like to watch the entire series for free, all you have to do is go to tradersacademy.org. That's tradersacademy.org. Fill out the form, give us your email address, and we'll send you a link to the entire series. Plus, we'll give you a free copy of our Reprogramming the Trader's Mindset book, and we'll give you access to a free 1/2 hour private coaching session. So if you'd like to take advantage of this offer, again, that's tradersacademy.org, tradersacademy.org, and thank you for watching.